For decades, the US dollar has been the world's dominant reserve currency. It facilitates international trade as approximately 54% of all international exports are billed in US dollars. However, that dominance is gradually eroding. Rising geopolitical tensions and economic uncertainty caused by President Donald Trump's tariffs and trade policies added strain to the global economy. These actions have placed downward pressure on the US dollar, leading to a decline in its value and trust globally. At the same time, gold accumulation and its prices have been rising around the world. Many countries, particularly China, which holds the largest foreign exchange reserves in dollar-denominated assets, have been gradually increasing their gold reserves. In this video, we'll explore why the dollar's decline is closely linked to the rise in gold prices. We'll also look at how trade policies, like President Trump's tariffs, influence this relationship, and whether gold could eventually replace the dollar as the world's primary reserve asset. To answer these questions, let's first take a step back and understand the bigger picture. Gold and the US dollar have a deep historical connection that continues to influence financial markets today. From the gold standard and the Bretton Woods system to the current fiat era, gold remains a key element in the global financial system. Before World War I, gold was the most widely accepted medium of exchange around the world. Its intrinsic value made it a trusted store of wealth and a stable standard for trade. Over time, gold evolved into a basis for paper money, which governments began issuing as a more convenient form of currency. However, the period between World War I and World War II was marked by significant financial instability. Countries with their own currencies experienced volatile exchange rates, often manipulated for national interest. Some governments deliberately weakened their currencies to boost exports. Many countries also adopted protectionist trade policies, including high tariffs and export subsidies to protect their domestic industries. This lack of monetary coordination led to trade imbalances and sparked economic conflicts between nations. After World War II, to stabilize the global economy and prevent future conflicts, the Allied nations met in Bretton Woods in 1944 and established the Bretton Woods Agreement. This agreement pegged national currencies to the US dollar, which was convertible to gold at $35 per ounce, effectively making the dollar the central global currency. Additionally, the International Monetary Fund and World Bank were created to manage the system. However, by the late 1960s and early 1970s, the US faced growing economic challenges, including inflation and trade deficits. This resulted in a decline in confidence in the dollar, and countries began converting their dollar reserves into gold, putting more pressure on US gold reserves. Following this, President Richard Nixon in 1971 officially ended the dollar's convertibility into gold. This marked the collapse of the Bretton Woods system and the beginning of the paper currency era, where money is backed by government trust rather than gold or other commodities. Despite the end of the gold standard, gold continues to play an important role in the global financial system. Central banks around the world still hold gold as part of their international reserves to maintain financial stability and hedge against currency risk. Today, gold is priced in US dollars on international markets, which creates an inverse relationship between the value of the dollar and the price of gold. When the dollar weakens against major currencies like the euro, gold becomes cheaper for investors using those currencies. This increases demand and drives up the price of gold. On the other hand, when the value of dollar strengthens, gold becomes more expensive in other currencies, which reduces its demand and often lower its price. For example, during the 2008 financial crisis, the dollar weakened significantly, and gold prices surged. Similarly, in 2020, amidst the COVID-19 pandemic, gold reached record highs as the dollar faced pressure. One key reason that contributes to the weakening of the US dollar is the United States' high level of national debt. The US has been borrowing money for decades by selling treasury bonds. China and Japan are the largest treasury bond holders of the United States. In exchange for buying these bonds, these countries earn interest payments from the US government. This has been a stable and profitable system for many nations, which has helped keep the dollar strong. However, the dynamics are changing. On April 9th, President Trump announced new tariffs on various countries, including China. As a result, countries lost confidence in the US economy, resulting in a decrease in demand for the US Treasury bonds. As demand fell, interest rates on these bonds began to rise. Whenever interest rates on Treasury bonds rise by even a small basis point, the US faces potential losses amounting to billions of dollars. This is because the US must print more dollars to pay the interest on the bonds. As investor confidence in US assets weakens, the US is compelled to offer higher interest rates to attract buyers. If demand remains low, the need for even higher rates could further devalue the dollar. Additionally, China and Japan hold significant amounts of US Treasury bonds, and their decisions to sell or hold these bonds could have major consequences for the value of the dollar. Japan held US Treasuries worth approximately $1 trillion as of January 2025. However, this figure is down from the $1.21 trillion it held 5 years ago. China, the world's second-largest economy, currently holds around $760 billion of US Treasury bonds, down from $1.07 trillion 5 years earlier. As the largest holders of US Treasury bonds, these countries are unlikely to sell them in mass amount openly, because selling bonds in large amounts could lead to a sharp decline in their value, causing financial losses for both China and Japan. However, there are signs that China is quietly selling its US Treasury bonds. In 2013, China held a peak of $1.3 trillion in US Treasury bonds, but by 2025, that amount had decreased to $760 billion. This reduction in bond holdings could signal that China is preparing to move away from the dollar, although it is doing so carefully to avoid causing a market panic. As more countries move away from the dollar and seek alternative assets, the pressure on the US dollar will continue to grow. The increased demand for gold is a direct response to these shifts. Investors see gold as a more stable and reliable asset compared to the dollar, which is under increasing pressure due to tariffs, rising interest rates, and the US's growing debt. Additionally, US tariff and trade policies also influence the value of the dollar. The recent implementation of reciprocal tariffs in several countries, including China, has created uncertainty in the global economy. Although many of these tariffs were paused for 90 days to lessen their economic impact, the initial announcement led to a decline in the dollar's value and a rise in gold prices globally. While the US is struggling with rising debt and a weakening dollar, something else is happening in global markets. Countries, especially China, are increasingly turning to gold as a safe investment. For the last several months, China has been adding gold to its reserves every month. This is a significant shift because, for many years, China and other countries have been investing heavily in US Treasury bonds. The shift towards gold is partly due to the increasing concerns about the stability of the dollar. Gold, unlike the dollar, is not dependent on the economic conditions of any single country or government. It has been seen as a safe haven for centuries, especially during times of economic uncertainty. While the US government continues to print dollars to manage its debt, gold remains a limited resource that cannot be devalued by increasing supply. As China continues to buy gold, other countries are following suit. Financial institutions around the world are raising concerns about whether gold could eventually replace the dollar as the world's primary reserve asset. While this shift is still in its early stages, the growing interest in gold highlights a larger trend of countries diversifying away from the dollar. In addition to gold, some countries are exploring alternatives to the dollar for international trade. The BRICS nations are pushing for the creation of a new currency that could challenge the US dollar's dominance. This effort, known as de-dollarization, is part of a broader strategy to reduce reliance on the US dollar and increase the influence of other currencies. As President Trump's tariffs continue to disrupt global trade, the US dollar is facing growing pressure. The rise of gold as a safe haven asset increased interest in alternatives to the dollar. While the dollar's dominance is slowly declining, it still plays a central role in the global financial system. In 2025, it accounted for about 57% of global foreign exchange reserves, down from 65% a decade earlier. Additionally, the dollar is used in nearly 88% of foreign exchange transactions and is involved in over 50% of global export invoicing. Despite the declining trend in the dollar's global dominance, it remains the primary international reserve currency and is unlikely to be supplanted by gold in the foreseeable future.